Ever feel like those quarterly earnings reports companies put out, the ones that are supposed to show how well they're doing? Sometimes it feels less like a clear picture and more like one of those funhouse mirrors at a carnival, distorted,
I know what you mean.
We're diving deep into that very question today.
It's a good one.
Because let's face it, everyone wants to see those numbers go up, 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 right? But are companies actually playing games with their earnings to make things look a bit rosier than they actually are?
Yeah, it's a question analysts have been grappling with for a long time.
And get this, we've got a fascinating study to unpack today. It digs into how often companies might be, shall we say, getting a little creative with their accounting.
This is interesting stuff.
The researchers didn't just crunch the numbers. They went straight to the source, the executives themselves.
Getting it straight from the horse's mouth, I like it.
We're looking at measuring the prevalence of earnings manipulations, a novel approach. It was just published in the Journal of Accounting Research, so it's hot off the press. What this study gets at is a challenge that's been keeping financial analysts up at night for years now.
And that is?
How can you really tell if a company's financial reports are a reflection of genuine business performance or if there's some clever number crunching going on behind the scenes?
Right, because on the surface, everything can look squeaky clean, but then you dig a little deeper and yikes.
It really is like trying to figure out if that amazing online deal you found is the real deal or if there's a hidden catch buried in the fine print.
Exactly. And that's what makes this research so compelling. They've used a really innovative approach, a blend of good old-fashioned surveys with a clever experimental twist.
Let's talk about that twist. They call it the list experiment.
Have you ever heard of that?
I have, but I'm sure many of our listeners haven't, so let's break it down.
Sounds good.
So imagine you're an executive, right? You get this list of statements, some about everyday business stuff, pretty mundane things.
Right.
And then others about, shall we say, less than above board financial practices. Things that might make a regulator raise an eyebrow.
A little creative accounting, as you said.
Yeah, exactly. But here's the genius part. You don't actually have to say which statements are true for you, just how many of them are.
Oh, that's interesting.
So it's like a layer of anonymity. Makes sense. Executives are more likely to be honest if they're not worried about getting called out specifically.
Precisely. It removes that fear of being singled out, It makes it much more likely they'll answer truthfully. It's kind of like a confidential survey, but with much higher stakes.
Much higher stakes indeed.
Yeah.
So they're given this cloak of anonymity, which you would think encourages honesty, right? And then they get into the nitty-gritty of these financial maneuvers.
Exactly. And what they found was pretty eye-opening. They looked at, over a 5-year period, more than a quarter of the executives they surveyed admitted to at least some form of earnings manipulation happening at their company.
More than a quarter. That's a pretty significant chunk of the corporate world.
It is. It really makes you wonder.
It does. It makes you think maybe that old saying about cooking the books isn't just a colorful metaphor, huh?
It makes you wonder. And what I find even more interesting is the breakdown of how they're doing it. The study dug into that a bit and identified 5 distinct types of earnings manipulation.
5. So it's not just one-size-fits-all creative accounting.
Nope. There's a whole menu to choose from, apparently.
Okay, so let's break those down for our listeners. What are we talking about here?
So the first type, they call it real earnings management. And this one, it's a bit more hands-on than just, playing around with spreadsheets. They're actually changing the way a company operates just to hit those short-term earnings targets.
So it's not even just about making the numbers look good on paper. It's about actually shifting their business practices to make those results a reality.
Exactly. You could think about it like, think about things like postponing necessary maintenance to save costs, or maybe cutting back on research and development. Decisions that might look good on a quarterly earnings call, but could end up hurting the company down the road.
Right. It's like a business going on a crash diet. Sure, they might look slimmer for the moment, but it's not exactly a sustainable strategy for long-term health.
I like that analogy. And, the question is, how common was this type of manipulation? And the answer is surprisingly common.
Really?
Yeah. Nearly 30% of those executives admitted to some form of real earnings management.
Wow. Okay, so what's next on our list of accounting shenanigans?
All right, next up we've got disclosure obfuscation, and this one, it's all about playing hide and seek with important information.
So less about outright lying and more about making the truth really, really hard to find.
You gotta think about it like this. You're trying to track down information about a company's environmental record, right? But instead of clear, easy-to-find reporting, it's buried deep within a mountain of technical jargon.
Buried in some footnote on page 300 of their annual report.
Exactly. And it's written in a way that only a lawyer could love.
It's like trying to find a needle in a haystack, but the haystack is made entirely of legal documents and financial statements.
And you probably need a magnifying glass, too. So how many companies fessed up to this tactic? Only about 4%.
Really? Only 4%? I would guess more, to be honest.
Well, it's tough to measure, right? Part of what makes it effective is that it's so hard to detect.
Good point. What's next?
All right, now we're moving on to accrual-based earnings management. This one dives into the nitty-gritty world of accounting rules and how they can be, let's just say, interpreted.
So this is where we get into those accounting loopholes and creative interpretations of the rules.
You could say that. Think of it like this. Let's say a company spends, $1 million on something. Now, this expense, it could be categorized as either a one-time expense, or it could be classified as a long-term investment.
Okay, I see where you're going with this.
By classifying it as a long-term investment, they get to spread that cost over many years, making their profits in the current year look a whole lot larger.
So it's all about timing and presentation, right? Making those numbers dance to a slightly more favorable tune.
Exactly. It's like choosing the right filter for your Instagram photos.
Okay.
And the study found that about 5.4% of companies admitted to using accrual-based techniques.
Interesting. What else is on the list?
Okay, so the next one, it's material omissions, and it's pretty straightforward. They're intentionally leaving out important information that investors probably should know.
So not even trying to bury the bad news. They're just leaving it out of the story completely.
Basically, a classic case of what you don't know can't hurt you. Or in this case, what investors don't know might hurt them later.
Exactly. And how common was this tactic?
This one was a bit less common. Only about 3% of the companies admitted to it.
Okay. So that brings us to the final type of earnings manipulation, right?
You got it. And it's the big one. We've arrived at accounting fraud. This is the kind of stuff that keeps CEOs up at night.
This is the kind of stuff that makes headlines, right? Destroys companies, sends people to the big house.
That's the one. Illegal, unethical, incredibly damaging to the integrity of the financial markets.
I mean, it's pretty blatant. You'd think it wouldn't be that common.
You would think so, right? But unfortunately, it's more prevalent than you might imagine. This study found that a staggering 12.4% of companies admitted to engaging in some form of accounting fraud.
12.4%. Are you serious? That's surprising, to say the least. 12.4%. I mean, it's a stark reminder that not everyone plays by the rules, even when the stakes are that high.
It really is. And, it highlights the importance of research like this, like the list experiment.
How so?
Well, it gives us a way to kind of, pierce the veil, get a clearer picture of what's really going on. Because we can't fix a problem if we don't even know how big it is, right?
That's a good point. I mean, it's not just about catching those who are being deliberately misleading, but maybe even more importantly, understanding what leads companies down that path in the first place, right?
Absolutely. If we can get a handle on why companies might feel the need to, play fast and loose with their numbers, maybe we can start to create a system that encourages more transparency and accountability from the start.
Right. It's about building that honesty into the system itself, rather than just trying to catch the bad apples after the fact.
Exactly. A culture of honesty and responsibility where companies are rewarded for sustainable growth for the real deal, not just short-term gains achieved through creative accounting.
So, as we try to make sense of these complex financial reports and all those earnings calls, what are some things our listeners should really keep in mind? What's the big takeaway here?
The big takeaway, don't take everything at face value. Dig a little deeper, Ask the tough questions. Don't be afraid to go beyond those glossy headlines. Remember, those stellar earnings reports might not be telling the whole story.
It's about thinking critically, not just about the numbers themselves, but the potential consequences, both for the company and for the market as a whole.
Right. And that's where you, the informed investor, you have a role to play. Because when you demand greater transparency, when you scrutinize those reports, ask those tough questions, it can actually help shift the balance, move things towards a more accountable and ultimately more sustainable financial ecosystem.
So a lot to think about from this research. Is there anything that stood out to you as particularly important, something our listeners should really take away from this deep dive?
For me, it always comes back to the importance of knowledge. I mean, we've seen how easily information can be manipulated, made unclear. But when you arm yourself with knowledge, when you understand the tactics being used, you become a savvier investor. You can advocate for more transparency, call companies out when needed.
It's that old saying, knowledge is power, right?
It's true, especially in the world of finance. The more you know, the better you are at protecting yourself, making smart choices, and maybe even pushing for positive change.
And that's what we're all about here at The Deep Dive, giving you the insights, the tools you need to cut through all the noise out there, understand the issues that really matter, make sense of the forces that shape our world.
So next time you're scrolling through those financial reports, maybe those earnings reports that companies put out, keep in mind what we talked about today. Don't be afraid to dig a little deeper, question your assumptions, demand more from the companies you're trusting with your investments.
Because a little bit of healthy skepticism combined with the right knowledge, that's a powerful tool for any investor.
Couldn't agree more. That's knowledge you can take to the bank.
This has been a fascinating deep dive, and I hope our listeners found it insightful as well. Until next time, keep asking those tough questions.